Stocks are a very common investment in the investment world. Generally, if one is building a portfolio, they really can't go about it without having some sort of allocation to stocks. Stocks, however, can be quite confusing for people. There's a lot of different components and moving parts to it. It reminds me of the time my boys, when they were younger, we started saving for them, and I wanted to encourage them to understand the process and start to learn about investing. And so I was explaining to them one of the components of stocks is that you get to own part of the company. And of course, they wanted to buy stock in companies that they knew, and you know the names, some big names, obviously. And they were so excited. They were like, "Oh, Dad, we get to own this company." I'm like, "No, no, no, no. You just get to own a very, 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 very tiny part of it." And so, stocks, it can be great to be a part owner, but there comes a lot of complexity when we're thinking about stocks. And so, I'd like to talk through a few of the things that I think about whenever we're considering investing in stocks. The first thing is ownership. So, a stock is part ownership of a company. And so a company issues shares to shareholders, and those shareholders own that company. And so depending on how many shares you have, that depends on how much of the company you own, because there's only a certain number of shares that a company will issue. And so you get to be part owner of that. And so as part owner of that company, you get to enjoy the rewards of the company. If the company does well, if it increases sales and revenues and profits and all that, hopefully the value of that would go up. But at the same time, not all companies are always successful. So you also participate in the downside of that as well. And so it's really ownership of that company, and what it gives you the right is the ownership to those future cash flows of that business. So the income that that business produces, as a stock owner, you get to participate in the revenue of that. And so the first thing is the ownership consideration whenever you're owning stock. And so it's a different mindset than putting money on deposit at a bank, or even investing into bonds or any sort of other any other sort of investment. A stock is part ownership in a company, so you're going to have the ups and downs of that company. The second consideration are the potential returns. We invest because we want to gain some sort of return, and that's a good thing. And stocks historically have really provided strong returns since for the past 100 years. You're looking at really strong average returns, and those returns come really in twofold: capital appreciation, and so that's the value of the stock increasing over time, and the value increases generally because of a company's has stronger earnings, and so they're earning more money and they're growing their earnings over time, and so that helps the value of the company. There's a lot of different things that helps in the value of the company, but you have the capital growth of the stock over time. The second component of potential returns are dividends, and dividends basically is just a return to the shareholders of profits. And so every company may issue a different dividend. There's some companies that don't issue dividends at all. There's some companies that's all the return that they're going to give you really is dividends, because they're not really strong growing companies. They've kind of hit a plateau. They've hit a certain market cap, and then they're just going to pay dividends as a form of return. And so those are the potential returns. When it comes to stock investing, you have both the capital growth potential and dividend potential. And those companies that offer those different types of returns are going to then provide potential different risk appetites as well. So that's the third thing to think about, is what are the potential risks to a stock investment. The main risk that most people experience is the depreciation of the stock value. We think about times early 2000s during the tech bubble, during the great financial crisis in 2008, 2009. When we think about COVID, you had stocks that were that dropped by 20, 30, 40, 50% in value. So to put the number on that, let's say you have $1 million and you're invested all in stock. that 30% drop is $300,000 drop. So a lot of people understand the risks when it comes to stocks. They certainly love the potential return, but also the risks is that potential drop in value. Now, with an individual stock, we also have company-specific risks. So not only things that, so like the Great Financial Crisis was sort of a systemic risk across all of the market. All pretty much every company dropped in value. However, there's individual company risk as well with an individual stock. So that company that can be good or bad. So it can be that one company can perform really well, and historically, the majority of stock market performance comes from just a handful of companies that do really, really well, and everybody else kind of trudges along. However, the inverse can be true as well, and that's a major risk with individual stock owning is the company could go bankrupt and you could lose all of your money in that company. That has happened to some very big name companies over the years. And so that's a major risk that one needs to consider when investing into stocks. Now, the fourth consideration is how do we actually go about evaluating which stocks to invest in? And so this could be and is an ongoing discussion, and there are a lot of different metrics. The two main schools of thought are what are called fundamental analysis and technical analysis. And so fundamental analysis is where you're looking at the company itself, you're looking at the overall economy, and you're making the decision to invest into something that you believe will do well over time because there's good people working there, they have good processes, they have good technology or good products. There's what you believe is a competitive advantage to that company, and it's at a fair price relative to what the market is. So you have to look at the earnings and the revenue, the sales, the debt, the cash on hand, all of that. You do some analysis to then come up with this seems like a solid investment, and within the overall economic scheme of things. So that's fundamental analysis. Then there's also technical analysis, and so technical analysis is concerned less with how the company operates, its revenue, its cash, its profits, all of that stuff. And what the technical analyst is trying to look at is they're basically looking at the charts within the market and deciding based on where the market is a company undervalued or overvalued. And so usually they're using things like a 50-day moving average or a 200-day moving average. And so they'll see the value of the company over time, and generally over time prices return to the average is an assumption within that technical analysis. And so if it's above the average, then that's probably a time to sell it. If it's below the average, and then that's a time to potentially buy it. And so that's how technical analysts work. They're basically looking at different charts, and there's all different sorts of patterns, and it gets really complicated really quickly. But the main thing that a technical analysis is they're not necessarily looking at the specific company. They're looking at more the broad market and the patterns, and then that helps them identify what companies are out of step, and that will then give them an idea of which sort of action to take. Now, the fifth thing that I want to talk about is the difficulty in evaluating individual stocks. It seems almost simple to think, oh well, this is a good company, I'll invest in this and just hold on to it forever, or this is a short-term thing, or whatever it is. Historically, though, it has been shown that it's almost impossible, very, very difficult to beat the overall stock market. The S&P 500, for example, is 500 large US-based companies. There's a lot of other different indexes, but historically, it's been shown very, very challenging to invest into individual stocks and do better than just the overall market. And a lot of it has to do with individual company risk and the fact that we as humans don't have the ability to see all of the different variables and factors. And so when you have literally millions of people investing, the market can move very quickly, and it's very challenging to beat the market. Now, with that said, there's certainly things that one can do, um, based on their own preferences and their own style, with the tax ramifications, all of that factors into what sort of investment strategy one should choose. And the sixth thing that I really would want to go over when we're talking about stock investing is the time frame involved. So when investing, one of the key fundamentals is understanding when do you need the money by, and that gives you the allowance to wait on investing and letting the investment work over a period of time. So stocks, for example, over any given 1 year period, they could be up 40% or down 40% or worse. However, over a 5 year period, if you were able to wait 5 years, then the likelihood of them being down is very small. It's less than 5 or 10% chance that your stock investment will be down over a 5 year period. If you extend that even further to a 10 year period, it's even less than that chance of a stock being down. And over a 20 year period, it's even less than that. Of course, that's more the market rather than individual stocks. Every individual stock it can vary widely, mainly because of the individual company risk. So those are some ways when you think about investing in stocks. How do they work? Things to be thinking about. That's what I think about when I think about investing in stocks. And certainly there's more to it, but hopefully that gives you a good overview of what to do there.